All right, guys, give me 1 second. We're gonna check and make sure the stream is up and looking good, sounding good, all that technical razzle dazzle. All right, guys, give me. All right, well, that was the feedback I was looking for right there. Let's get into it. I am the Climb to One. This is YouTube. I don't think you just stumbled there by accident. And this is Stocks, a small tutorial on call options, because nobody does clickbaity titles like me. I'm the champ. See how original that was? That's mind-blowing. What a title. All right, let's get into it. This is a small tutorial on call options. I am using my Robinhood account. We have recently started trading again. January 22nd of 2024 for this account. All right. Yay, we're up. Up is good. We like green. All right. We're here to talk about call options. So I'm going to go into my actual call option. First thing to understand about call options. Call options require that you have 100 shares of the stock, and it only works in 100 unit increments. All right. I'm going to call that a lot. Sometimes I'll call that a block. Okay. Sometimes I'll just call it 100. The terminology is a little flexible, but that is what it is. All right. You need 100 is the important thing. Okay. Well, Brad, I have 100 shares of stock now. Well, that's very good. We're going to say that you have 100 shares of Mark. Why? Well, because that's what I have. We're not going to work in hypotheticals so much. I'm going to have to do some hypotheticals for explanation's sake, but we're going to work in realities. I have right here 100 shares of stock of Mark. All right. Boom. Beautiful. Because I have that 100 shares, I can trade Mark options. Well, we've already done that. We've got it right here. We're going to go over that. I think I'm going to use notification. Actually, let me take a look here and see if just at a glance I can have everything that I want to talk about here. We're not going to get into Delta, Gamma, Theta, Vega. No, we're not. This is all volatility factors and stuff like that. This is complex stuff. This is smart people stuff. We're here for a tutorial. Sell Mark, $1 call, 216. Let me read over this. Fill the contract, the limit price. Okay, so this is it. This is the information I needed. I thought when I did this, 5-cent limit price, right? Well, it's going to get you the best price it can without going below your threshold. My threshold was 5 cents for the contract. What are we even talking about? 5 cents for what contract? Well, this is what the option is. The call option is me saying, hey guys, I have 100 shares of this stock, in this case Mark, and I will sell that to you at $1 a share. That's going to be the strike price. $1 a share is the strike price. And if it exceeds that price, you're going to say, hey, I'm calling you on this option. Got it. Here you go. I'm selling it. Doesn't matter if it went up to $100 a share. I'm giving this to you for $1 a share, our agreed upon strike price. Here are your 100 shares. Here's my $100. Now I'm going to win because I bought for less than $1 a share. So I'm going to win. I'm locking myself in on a W here. But I could lose on the potential gain, right? I'm imagining a world where this stock blew up to $100. That's going to make the guy who bought this contract off me very happy. I'm going to profit, but my profit stops at $1 plus the premium. We'll get to that in a minute. His profit isn't gated. His profit is however high the stock can potentially go to. That's his profit. Okay, understood. Understood. So what an options is they get the option to exercise our contract. This is a contract that if the price exceeds $1 at any time between now and the expiration date, that's what call 216 means. February 16th is the expiration date on this contract. Okay. So if the price exceeds the strike, that's the $1, then before 216, then I can call upon you for my option to buy. And there's no way out of it. If I call on it, you're selling. This 100 shares is coming over to me at the prearranged strike price, $1. Here's your $100. Here's my 100 shares. Oh, these are worth $100 a share now. I just got rich off of, they just got rich off of buying that call option. Okay, because I'm selling the call option. They're buying the call option. Okay, so we understand that my risk is only in excess potential gains. That's it. I would hope that I bought at less than strike price. So I'm locking myself in for profit. Got it. So I'm going to win, but I limit the potential of how much I'm going to win by. Okay. Well, why are they doing it? So now we know why I'm doing it. Why are they doing it? Well, there's a couple of reasons. We're going to get into concepts of leverage and other people's money. That's rich people stuff, right? That's rich folk. Normally, we deal with the money that we have, and we're being leveraged against. We're not leveraging on. We take the loan from the bank. We get issued the credit card. They are leveraging us. We are not leveraging them. Well, let's say I don't have $100. Let's say I don't have the money to buy 100 shares. I can't buy 100 shares of the stock. I don't have the money. How can I do something? Well, I look at the mark price, I look at the value of the stock, and I go, okay, I think I've done my research or whatever, or I'm gambling. I'm just talking out my mouth, right? Like, hey, I don't know, but we're going to throw a Hail Mary here. Could be either way. You should probably do your research. You should probably learn some things, right? Probably educate yourself. Probably don't just do blindly what other people say, but, learn. There's a process. You don't have enough money to buy 100 shares of Mark. Well, I still want to try to make some money in the stock market. So what you're going to do is you're going to say, in this hypothetical, in this scenario, okay, what I do have is I have $10. What can I do with $10? I can buy, in this scenario, a call option at a strike point of $1. And I will pay this guy right now $10, 10 cents a share. It's the premium. I'll pay him $10 that at a future date, if the price goes above the strike, he has to sell it to me at that point. Okay. You still don't have enough money to buy 100 shares though. Right. But it didn't just go to $1. It didn't just go to $1. It went to $1.50. So there's a mechanism in place. I own this contract. That's what I own. I don't own the stocks. I own the contract to buy the stocks at this rate. And now the market has said, yo, these shares are $1.50. I am exercising that option. I am calling that option. Boom. But what's happening is at the same time I'm calling the option, there's a mechanism in place that I am selling those shares. So it's almost like we're not getting into the extreme technicals. We're going to say it in the layman's way, right? That's what tutorials are for. It's almost like he's holding those shares for me, but I'm going to be allowed to sell those shares upon exercising the option, upon execution of the contract. I'm going to sell those shares. I still don't have the money to buy those 100 shares. I owe you $100 more because of our strike price. I'm selling the shares first. Through the proceeds of that sale, your money goes directly to you, and the leftover comes directly to me, and the stocks go from you to me for a split second to whoever I sold the shares to at the new valuation. So with $10, this person, if he wins the deal, right? This person that bought my contract is thinking, I can't afford 100 shares, but I can afford $10. And with that $10, there's a profit of 50 over here because it goes up to $1.50 in the hypothetical future before the expiration date on the 16th. Shoots up to $1.50. I call my option. I exercise that. It's going to sell instantly. My $10. Now I now have $40 in my account. Why 40? Well, because it didn't just cost them $10. It cost them $110, right? He had to pay the $10 premium to get the contract, and he has to pay me $100. So when he sells for $150, he's profited. He's going to have 50 in his account. I'm sorry, but he's profited 40 is what he's profited. So everything gets covered like that. So it's this interesting system of things executing upon the exercise of the option when it hits. That's why they're doing it. They're doing it because they don't want to hold 100 shares of something, or they can't afford to hold 100 shares of something. Either reason is a viable reason. I'm not paying $60 to get 100 shares of Mark. Not doing it. Why? I don't particularly care about Mark. I don't want to invest in Mark. Okay? Or, hey, I'd like to invest in Mark, but I don't have $60 for 100 shares of Mark at 60 cents a share. I don't have it at $10. So you're either doing it because you don't want the stock in the first place, you're just trying to get the flips. So you don't want to hold it. Why? Well, because if you spend $60 to hold 100 shares of Mark, and then it goes down to 50, it goes down to 40, you can't use that $60 anywhere else. Here, you know, by the 16th of February, we're done. I either flip the shares or I'm out that $10, and it's on to the next one. You're not getting locked in, and you're not getting locked in at losses. The most this guy can lose is his $10. That's it. That's all he can lose to potentially gain however much. So that is why you would buy a call option. I like to be on this side. I like to sell the call option. I like to buy below strike points. I like the call option to not get exercised, so I keep getting premiums. And that's life. And then if it ever sells, it sells for more than I bought it at, and I got all these premiums. It's a beautiful win. Okay, well, let's look at some of that stuff. I think I've explained now the idea of how this works. What are the numbers that are important to us? Well, we filled the contract, one contract, at 10 cents. Well, what does that mean? It means that he is paying me, this is what we call the premium, 10 cents for us to enter this contract. But this contract isn't for one share, this contract is for 100 shares. So that 10 cents is multiplied per share. 100 shares, $10, right? So I get paid a premium upfront to enter this contract of $10. That is a 10 cents per share. Well, this gives good information. Right here, you see something called limit price. I was willing to take 5 cents a share. I was willing to fill this contract for $5. We got lucky. Valuations moved, stuff changed, and I was able to get a contract at 10 cents instead of 5 cents. That benefits me. That is more profit for me. It is more risk for them. Instead of being able to try this play at only $5 cost, it's costing them $10. All right. Regulatory fees. All right. So out of that $10, they took 3 cents to make this transaction happen. So that's the regulatory fees. So I didn't get a full $10. We're going to say I got $10. I actually got $9.97 is what I got. And then, you know, Robinhood and the big industrial complex of stocks got 3 cents. Doesn't sound like a lot. It's not a lot. Doesn't hurt me at all in this. The difference between $9.97 and $10 is negligible to me. I'm not going to not do this because of 3 cents. All right. But think about how many options happen daily. 3 cents here, 3 cents there, millions and billions of options being sold. That's a lot of money in the system, right? I just want you to get an idea of that in the system. Okay, well, Brad, how'd you tell them that you wanted 5 cents? And how did you end up getting 10 cents? Oh, well, let's take a look. Up here is limit price, right? You can plug all this stuff in manually. Tells you how long you're going to have this offer on the table, right? All that good stuff. This is a little beyond where it started, though. Well, what do you mean? Let's go back to marking that 100 shares. Trade mark options. Now, again, this is Robinhood. This stuff could be all located. The UI could be different for what you're running on. Let's actually look at the calls. And also, you can buy, you can sell, and you have calls, you have puts. We're not dealing with puts here. I don't do puts. I'll do a tutorial on puts eventually, but I don't do puts. We're working on calls. You see here, currently, they have little ask prices set up. This is going to give you some idea, some indicator, right? Why is somebody going to risk $10 for a stock to hit 250 when the stock's currently at like 65, 70 cents, right? So this is why it gets lower. To make people more willing to do the greater risk, because they give up less money to begin with. It costs them $10 to make this one happen. Only costs you $5 to make this one happen. This one is much more likely to not happen than this one, but that's the idea. They do a really nice thing here too. They give you break-even prices. This is what the stock share has to get to for you to make your money back and break even. But if you're the one buying call options, you're the one doing this screen, you don't want to just break even. You're treading water that's horrible. You're looking for pops. You're looking for swings. All right. So what I did is I said, I'm going to sell a call option. Pretty much all exactly the same thing, except over here, there's no interest. See here, somebody's kind of interested. Somebody's doing something. There are people that hold 100 shares that are saying, I'll take $5 if you agree to a strike price of $250. There's interest here in selling them and moving them out. But on this end, right, there's nobody that's like, yo, we're doing this at $250. You're not finding people that are going to flip it for you. 5 cents. Well, that was at 5 cents that I had agreed upon. I said, hey, we'll do, at worst, the least I'll do is 5 cents per share, making it a $5 contract. Well, volatility, implied volatility, 300, almost 80%, right? This stock fluctuates wildly. Within the last 3 days, business days, because we just went through a weekend, it's been under 60 cents. It's been down to like 55, 53 cents, and it's climbed up, I believe, 75 cents. Those are wild swings. So at the time the person executed, the price of the stock had to be higher, had to be closer to $1. They probably bought this when it was sitting at like 68, 70 cents per share. That means this price had went up during that time. I don't do anything with this. This stuff all gets calculated for risk and volatility on its own. So I'd put in when the stock price was lower. Because the stock price was lower, they had further to go to get to that dollar. At that time, only $5 would have been the deal. But since it was closer, it was much more likely to happen. You got to pay a little more premium now because you're a lot closer. You're not having to make a long climb. You only have to make a short climb. That's going to cost you $10. So that's how that works. So for me, having the 100 shares, I would like to lock in when the price is kind of close to the strike mark, but I still don't think we're going to hit it, right? If I get this at 90 cents, this might be 15, 20 cents a share, potentially, right? When I'm doing it down at 50 cents a share, this is going to be at 5 cents, right? So that lets you understand. The closer the value of the stock is to the strike price, the greater the premium. But you see up here, expiring 16th of February in 11 days, right? Okay. But, oh, look, March, April, July, we're talking 39, 74, 165. We come out here, there's a greater premium. Why? Because they're taking less risk. Up here, there's more risk. The more risk they're taking, the less their premium, right? If it's 50 cents instead of 75 cents, and the strike is $1, then this is lower because there's more risk. If it's next week versus 6 months from now, less time for them to potentially hit their mark. Their risk is higher, the premium is lower. If the stock was sitting at 99 cents right now, and the strike mark was $1, and you jumped all the way out 165 days later, you have almost no risk. You have almost no risk. Your premium's going to be big, right? So remember, the more risk they're willing to take on, the less premium they're going to pay you. The less risk they're going to take on, the more premium they're going to pay you. The less risk, the more likely they hit their strike mark and call your option. So the risk you are taking is you might have to sell this at the agreed upon price. If it's 99 cents a share, I'm probably not going to sell an option at $1 strike mark unless I'm done with it and I've collected premiums for months and months and months and now I just want to get out of the position, then maybe. But if it's treated me that good, why don't I just go up to the next strike mark and deal from there and keep my shares, right? So there's a lot of options, a lot of strategy to it. But I just want people to understand why the person buying an option might do it. They don't want to hold 100 shares and wait for it to go up. They want to just do the option, and if it goes up, make the instant flip. Or they can't afford the 100 shares, right? That's why I'm on cheap stocks. I can't afford 100 shares of a bigger stock. The only way I get 100 shares is digging down here with a cheaper stock. So understand that. They're doing it because they don't have the money to buy 100 shares, or they don't want to hold the 100 shares. Because if they're holding the 100 shares, the value goes down. It could go down to zero. They could have $60 for 100 shares of Mark. Mark could go defunct tomorrow. They're out $60. With this, they only ever risk $10. That's the positive. You limit your risk. All right. On the flip side, why do I want to sell my calls? Because I want to have the 100 shares. I want to catch the premium. I want to buy more stocks of that premium to have more shares. And you would like to think that every time I'm buying at something lower than my cost basis. So I keep lowering my cost basis, increasing my potential profits, right? So that's it. There's not a super lot to understanding the reasoning. And I think that understanding the reasoning and the logic and the why does a person sell an option, why does a person buy an option is more important overall into getting into this than understanding gamma and theta, implied volatility. You should probably watch a tutorial that's going to go into the metrics, right? We're here right now on this one just for an understanding of what an option even is. Why might a person do it? Will I do it? Well, let's see. Which one am I doing? Am I going to sell options? Well, only if you can afford 100 shares of a stock. Then you can sell options. Okay, cool. I can do that. No, man, I can't do that. I'm starving in college. Okay, well, do you have $10? Now, it's a risk. You could lose the whole $10, but you could also flip that off a nice option sell. If the price goes up the way that you're hoping, now you have $40. Now you can buy more options for people who are selling them, right? So it's understanding how it all works. That's what we're here for. So now you know why you might sell options. Now you know why you might buy options. You know what a strike price is. This is right here, what the contract is going to execute at. You now understand what an expiration date is. This is when the contract comes either due or goes defunct. You understand the premium. You understand why the premium fluctuates. It's because of risk, which is a factor of price volatility, implied volatility, and time, expiration date of the contract. You understand that this is indeed, even though you didn't sign your name on anything, a contract. You are agreeing to buy or sell, depending on which call you're doing, 100 shares of stock at the strike prices. We're agreeing upon that. And somebody is paying a premium to be allowed to call that option, and the other person is being given the premium to put up that 100 lot and hold it there. You can't do anything else with it. It's there until the expiration or the call is triggered. All right? These are all the moving parts. These are all the things. Hopefully, I know I rambled a little bit. We're all over the place. Hopefully that explained it well. Now, I'm going to go in. I'll probably, in the near future, do one on puts. Think about it this way. If you are buying a call option, you want the price to go up so that you can make that money when it automatically triggers a sell when you exercise your option, right? We went over that. We did that scenario. Puts are kind of the other way. Puts, you're betting on the stock to go down. I don't like betting on the stocks to go down, but that's what puts do. Puts are the other side of the coin to call. If you're buying call options, somebody has the shares, you're trying to flip their shares basically. If you're selling the call options, you have the shares and you're either good with the price that you're going to get plus the premium, or you're hoping that it never gets called and that these contracts keep expiring and you keep banking on premiums. There we go, guys. That is the basics on buying and selling call options without going way deep into the matrices and maths, and now we're pocket protectors and our brains are hurting and calculators are exploding. This has been real. This has been fun. This is the climb to one.